here's what I've been saying, and this is the message advisors need. Now just look at the screen for a second, okay? Can you see my screen?
Mm-hmm.
If you had been doing asset allocation correctly over the last 25 years, and by that I mean is you hadn't owned foreign stocks and you hadn't owned commodities, and you had used U.S. large caps, small caps, stocks, bonds, cash, REITs, your portfolio would have returned 8 percentage points, okay? But the problem with that, and maybe the problem you're talking about, is that a huge contributor to that historic return, which came from fixed income over here kicking in compounded annual 5% over 25 years, and cash kicking in 2.5% over 25 years. And we know that's not today's environment. So as we look forward today, the way we need to be presenting this to clients is, at best, we might get 3% from bonds, and let's use 8% for common stocks, just being conservative. So that's a 6% weighted expected return, not the historic 8% that looking back. So again, your point about rear view mirror is really an excellent one. And because we can't look forward and expect fixed income returns like in the past, then you've got to reduce the whole expected portfolio return. And I still, I'm extremely emphatic about not owning foreign stocks, and for the reasons we've discussed. But that's not going to change, because this is what people are really glomming onto in my presentations. This is really important stuff. The key for advisors is to figure out. Well, let me back up. What I've been doing, Andy, is I've been going through this whole analysis of how horrible the advice from Wall Street has been. And we conclude that with this scattergram. And we demonstrated here empirically that Wall Street is actually stripping alpha from the recommendations you're giving. It's crazy to try to invest in the manner in which Wall Street firms are suggesting. So the question is, what do we do? And the answer is modern portfolio theory. Modern portfolio theory is the only approach to investing that's firmly based in the academic research. Well, that's got to tell you something. What is modern portfolio theory? Well, this is an article that I came across last year, and I thought, the last time I actually studied modern portfolio theory was 40 years ago in business school. So I read this carefully, and I said, this is a great way to explain it to financial advisors. Essentially, any advisors has available to him, the number I read the other day was 20,000 investable alternatives. I haven't verified that number independently, but if you add up the total number of stocks, ETFs, and mutual funds, that article said 20,000. Whatever the number is, it's thousands. For every individual asset, there's an ordered pair of data that is associated with it. It's called risk and return. So for every single mutual fund, for example, you know what the historic risk and the historic return was, let's say over trailing 10 years. So you can plot risk and return for every single asset. Now, what an advisor's assignment is to select a subset of the total investable alternatives out there, consisting of maybe 5, 6, or 10 discrete investments, starting with stock, bonds, and then cash, and cash, bonds, and then stocks of one kind or another. 5, 6, 7, 10 investments that from thousands that constitute the efficient frontier and that lie along the efficient frontier. And this is what Markowitz, Miller, and Sharpe got the Nobel Prize for figuring out. So for any given level of risk, you're maximizing the expected return. And this is where we get into a whole discussion about active versus passive management. Evidently, the statistics are showing that 95% of active managers are down here somewhere. So they're not optimizing, because according to the theory, you are guaranteed of being on the efficient frontier with maximum diversification. So ideally, you own the Russell 3000 in an ETF or something like that. Anyway, so now let's test it. let's test the modern portfolio theory. And again, here is the description of modern portfolio theory. And again, Markowitz, Miller, and Sharp got the Nobel Prize for figuring out that you stay fully invested, number one, then you diversify, you optimize and rebalance. By the way, what is optimizing? Optimizing is simply the term used to describe this process of kicking out something that lies here and replacing it with something that lies here. In other words, for any given level of risk, you need to know that what you own is apt to deliver maximum return. Now let's apply numbers to the historic data. And here what we're doing is, in this case, we're using a conventional view here that we need to own US small caps, large caps, foreign stocks, bonds, cash, REITs, and commodities. Again, in my meetings recently, Andy, I've been asking people, does this resemble the type of advice that you're getting? In other words, when you go on software platforms or whoever you're taking advice from, is this how they're telling you to diversify? And 99% of advisors saying, yeah, that's the way we understand it. US small caps, large caps, foreign stocks, bonds, cash, REITs, and commodities. Well, lo and behold, when you compute, and now we're using 25 years of actual data, you can compute the weighted diversified portfolio return using those 7 asset classes, and this is the way it would look. The individual asset returns are here. You can see over 25 years how each of them has appreciated or not. And then when you calculate the risk and return of each of those 25, they lie along here. And my point has been that if you were Harry Markowitz today and you sat down with a blank sheet of paper and you said, okay, I need to construct a portfolio, each of whose constituents lie along the efficient frontier, there is no way on earth that you would say that foreign stocks deserve a place in this diversified portfolio and commodities are even worse. Are you kidding me? An asset class that has done nothing in 25 years with maximum volatility? Absolutely not. The conventional wisdom is absolutely wrong in that the emperor has no clothes when it comes to giving this advice today. So now, if we substitute, and then I go on to say, do you know what you own? In other words, everybody in the room, and I've gotten people to raise their hands recently, 95% of every room raises their hands when they say they own foreign large cap stocks. And I say, is what you own benchmarked to the EFA? And they say, yeah, probably it is. It's foreign large caps. And then I say, do you know what you own? And no one does. And they admit that. And I say, you're not at fault for this. It's just that you've been given the conventional view and the conventional wisdom is wrong. Here's what you own in EFA. Start with 25% weighting in Japan. Well, here's the Japan stock market. Over 25 years, you've gone backwards in Japan with maximum volatility. Tell me again why you want to own that asset class. Then I go in to explain what happened. The question is, how did we get led down this road? This road being the conventional view being today that you need to own EFA, foreign stocks. The story, you have to wind the story back 30 years, and this is something that I remember in my business career, but most people in the room today have no idea that this is how it happened. In the decades leading up to the 70s, most American investors would no more have owned a foreign stock than a foreign car, just like my dad. He no more would have owned a foreign stock than he would a foreign car. Foreign was simply foreign to everybody in the United States. After World War II, there was no other game in town. And then the supernova appeared on the scene. The supernova was Japan. The Japanese stock market went from $1 in 1950 to 40,000. And then back in the early 80s, Japanese investors bought Pebble Beach and so on and so forth. The supernova, foreign investing, opened our eyes. The scales fell away from our eyes and people realized, man, there's an investing universe out there that is beyond the shores of the United States. We have to start being invested in this. But the problem was Japan was one and done. It was a one and done phenomenon because, as I say, from over the last 25 years, it's negative returns. Likewise, how about Europe? Here's an article talking about the incredible shrinking Europe. You really want a piece of that, do you? This index, this EFA index, 11% in that bastion of capitalism, France. Are you kidding me? How about Germany? You want to invest in Germany? Most of these country indexes are heavily weighted in the country's major banks. Deutsche Bank is the biggest bank in Germany, and it's on the verge of collapse. Tell me again why you want to own Germany. So my point here is, this is bad advice. Had you not done this, and again, I don't blame American investors for being committed as they are. I'm just saying that you need to reevaluate. You need to really understand what you own, and more importantly, look ahead and say, well, this experience that we just had over the last 25 years, when these two asset classes are clearly not eligible for a portfolio, is that likely to change anytime soon? And the answer is definitely not. If anything, US will look more increasingly attractive vis-a-vis IFA and commodities. So now let's recalculate the expected, the historic return of these portfolios. And let's assume that we hadn't owned IFA, but we had replaced that with the S&P 500. So we replaced IFA with US large caps, we replaced commodities with US small caps, and lo and behold, that portfolio plot, risk versus return, is here in the purple. Now that is clearly on the efficient frontier. It's just such an eye-opener. Now the question is, okay.
Wait. Could you just go back 1 second?
Mm-hmm.
The return that you're assuming here, are you double weighting then?
I'm double weighting
large US.
I'm substituting large S&P 500 for IFA, which means yes, we've double weighted.
It's okay. It's not actually double weighted, but you've compensated. You've taken the extra cash from IFA,
yes,
and commodities, and instead put it all into cash and large stocks. Is that what you did?
US large cap and US small cap.
What's the logic behind replacement of commodities and IFA with US stocks? Why specifically US stocks?
The logic is because if you plot IFA and commodities in this chart, that they are nowhere near qualifying.
I understand.
Okay,
but I understand the logic in using the US.
If you kick them out, then what would you have? You'd have a portfolio consisting of 5 asset classes. And if you compare that to what you have done, it's not a fair comparison, because your bond weighting, your cash weighting, REITs and real estate, cash and bonds then would be 20% each. Whereas you need to hold those percentages at 14% each to make a fair comparison. And at the same time, you don't want to present clients with a portfolio that consists of 20% each in bonds, cash, and real estates. That's a much too conservative portfolio. You need to hold those percentages constant and just rearrange the allocations to the risk assets, which are.
But why not? Okay, but why not then put more in real estate, which is a risk asset, isn't it?
You could. I could have done this differently, and that's absolutely a valid point. I could have said, but to keep it simple, I just said, let's replace IFA with. Okay, now let's split. Let's split this piece of the pie here. This all. Can you see my cursor?
Yeah.
So the real question is, okay, so how do you split the risk assets up? And your point is a great one. You could say, well, let's do equal shares, REITs, small caps and large caps. I could do it that way. And actually, you would probably enhance the results even further, I think, by doing it that way. But I kept it simple. I said, let's just replace foreign stocks.
Yeah, I just got hung up on that. I wanted to understand.
You are a very sharp, keen observer.
Oh, stop.
Oh, that's great. Okay, so the last point here, and the reason I feel so strongly about this, and I think we really need to shine the light on this for investors, is okay. In retrospect, we look back and we realize we made a mistake here by including IFA. And again, it had to do, and the reason we got led down that path is the Japanese supernova, Japanese miracle. And where in reality, those economies are not nearly as attractive as the United States going forward. So my question is, what did this cost us historically? And then by extension, well, if you continue down this path, what is this likely to cost you going forward in terms of the drag on your returns going forward? And the answer to that is in this chart. So now what we've done is to compute the total compound return of the diversified portfolio pursuant to the conventional wisdom, the red portfolio, okay, versus what would have been the compound annual return for the properly diversified portfolio, the purple. And lo and behold, the number is a whopping 40% differential in ending value. Holy cow, it's colossal. That opportunity cost is just enormous. And for people not to understand this today, I think it would be a big mistake. So to continue along the course of giving people advice that they need to own foreign stocks, in my opinion, is you know, it's really damaging.